Hey, Nick, I guess we can start.
Okay, let's start, guys.
Thank you.
So, warm welcome, everyone, to the webinar. Sorry about the technical issues. If you want to change the language, how you want to listen to this, you have the choices, I think, between 5 or 6 languages. Just go down at the taskbar at the bottom, and you should be able to find the languages that you are looking for. But yes, warm welcome to this new webinar. We're going to be talking all things investments, all things markets today. Let me briefly introduce myself. I'm Nick. I work as investment strategist, portfolio manager, working in the investment team in Luxembourg, helping manage the money for the forward quant funds. And we've prepared an interesting agenda for you guys today. Before we delve into that, though, let's have a look at something not so interesting, namely the disclaimer, as you can see here. Well, basically, please don't do anything silly with the information that we're going to give you today. That's essentially it. The lawyers want us to put it in, and we always got to listen to the lawyers. So here's the agenda, guys. So what are we going to do? 3 parts to the presentation today. So first things first, we're going to review January. How was January for the stock markets? It was a very tumultuous, volatile month. So we'll really try and unpack that for you. Part 2, we'll have a look at our positioning in the quant funds. How have we been doing? What have we been doing? What kind of rotations are we doing across the quant funds? Then in part 3, we'll have a look at some key questions, the kind of things that are keeping us up at night. We'll delve into those in a fair amount of detail. But let's get stuck in then with January in review. How was the month? Well, it was not a very good month at all, right? We saw quite a significant drawdown. So markets have started 2022 really in a highly volatile fashion. This is especially the case over in the United States. You can see that there on the right-hand side. The S&P 500 experienced a significant drawdown. The NASDAQ, much more tech-heavy, saw an even more pronounced drawdown. So really not a good month at all for US equities. And if we look at some of the more speculative areas of the market, right, stuff related to biotechnology, like gene editing stocks, or stocks related to crypto assets, those kind of things, there the losses have just been incredible, right? I mean, some of these stocks are down 50, 60, 70%. So really bad month for super high growth type of areas. If you look at markets outside of the United States, they have fared better. But if you look at the likes of Europe, there as well, we've seen a significant sell-off in January. So as promised, let's unpack this for you. What has been going on? Well, first and foremost, this is about the monetary environment. The main culprit behind this volatility is the monetary environment, right? So let's go through this. It's been known broadly since last year that central banks want to move into a more hawkish direction, a more restrictive direction. But what happened in January is that the expectations around this hawkishness, this more restrictive policy direction, that accelerated significantly. And this was due, for the most part, to the Federal Reserve. So it turned significantly more hawkish than what the markets were expecting. And what's going on? Well, the Federal Reserve is really concerned about the high inflation prints that it's seen over the last number of months. If you guys have been following the news, you would have seen over in the US, for example, inflation is running hot, right? It's running at over 7%. So it feels increasingly that its credibility is threatened and it's tightening policy. And this is having a host of ramifications across the financial markets. And one of these, the most important one, is we're seeing significantly higher rates. We see that especially at the short end, so short-dated bonds, but also at the long end. As you can see there, 10-year treasuries, there the yield has risen very, very rapidly indeed. That is not good news for stocks, in particular, not good news for growth stocks. And the United States has around 30, 40% allocation to growth stocks. So of course, the United States has been very badly hit in this type of environment. Now, it wouldn't be an investment update over the last couple of years without talking about COVID, right? And you can see that there on the right-hand side. COVID is absolutely exploded in January, right? This is due to the highly contagious OMICRON variant of COVID that appears to be highly contagious and is able to circumvent immunity provided by the vaccines and also previous infections. And you can see that there on the right, I mean, absolutely exploded. I mean, huge COVID numbers. And this, unfortunately, has had several negative repercussions as well for the market. So very simply, it just generates more uncertainty, or has generated more uncertainty around how governments will act. So will we see more restrictive measures? This adds to the overall risk in the markets. What kind of measures would they be? Are some countries going towards lockdowns again, like in China, right? It adds uncertainty. It also means that consumers have become a bit more wary, right? Wary of getting the virus, so you're less likely to go out to the restaurant, to the hairdresser, or consuming services in general. So services have come off the boil somewhat as well. And it also, here importantly, means that supply chains are potentially negatively affected once more, that they come under pressure once again, right? You see people off work. Like I said, some countries are going into lockdown. What does that mean for supply chains and these potential price pressures that have been building? So it adds to this fear around inflation that we've seen crop up over the last number of months. Last but not least, unfortunately as well, we have to talk about war. So you guys know the situation between Russia and Ukraine. Since last year, Russia has been amassing a fair amount of troops on the Ukrainian border, and it's been dialing up the diplomatic heat as well on the Ukraine and on the West. What's going on? Well, very simply, Russia wants to keep the Ukraine within its sphere of influence. The Ukraine increasingly wants to extricate itself from this sphere of influence from the Russians. And we're probably seeing a bit of foreign adventurism here as well, right? As you can see on the right-hand side, is that the polling for the Russian government has not been doing very well indeed over the last couple of years. And what they tend to do is they tend to turn towards nationalism and war in order to boost those approval ratings. We've seen that the last 15 years or so twice, so with the Georgian invasion back in 08-09, and also with the Crimean War back in 2014, right? They use war, this nationalism, to boost approval domestically as well. So the probability of war is going up, which again is not good news for markets. Again, it adds to uncertainty. Markets hate uncertainty. It thereby raises the risk premium currently in the markets. And of course, it also throws up a whole bunch of questions around the European economy, right? We're very energy dependent on Russia. And if prices go up significantly from here, what does that mean for European businesses? What does that mean for European consumers? Can they absorb these price rises, right? So a lot more risk has been added by this as well. And all of it is culminated in a pretty bad start to the year. There is no doubt about it. Now, the next question is, though, how have we been positioning within this? And here, remember, we do our investments via models and algorithms. And on the asset allocation side, what do we tell these algorithms to look at? We tell them to look at two facets that are really important to financial markets. So the monetary environment and the economy. So what are both of those things telling us, our algorithms, our models? Well, on the monetary side, we definitely agree what's going on currently in the markets, and what the models are telling us is not good news, right? The monetary environment is not good. As we saw, monetary policy is heading into a more restrictive direction. Interest rates are moving up. The Fed is tightening, of course. Inflation remains elevated, remains at high levels, will probably rise a little bit more from here as well. So the monetary environment, not good at all. But if you look at the economy, the global economy is still doing well. Our models are saying that the economy is still in good shape. Investment spending is still moving in the right direction. We see consumption is still supported. Yes, services, they have been hit somewhat by the rise of Omicron, to be sure. But if you look at the manufacturing sector, that continues to power ahead as well. And here, importantly, is that the good news on the economy can compensate for the bad news over on the monetary policy, monetary environment front. And here's an important chart that we showed you last month as well. What is really important for stocks is whether a recession is around the corner. You can see that here on the chart. Recessions are the shaded areas. That stocks only tend to go down for a prolonged period. What we need to worry about is if a recession is afoot. But what we can see is that a recession is not afoot. Global growth remains strong. That means that equities can catch their footing and once again perform throughout the year. We just need to be a bit patient for now, and we should stick with stocks. So the way that looks in our allocation, it means we keep that high allocation to equities in place, right? The growth environment is good enough to allow for performance to return. It means, however, that we have a low allocation to bonds, right? In an environment where growth is moving up quickly, inflation is moving up quickly, you do not want to be in bonds, for sure not. Where it gets interesting, however, within the equity side, there is a major rotation unfolding over the last month, and we are moving in that direction as well. Our models, our factor models, are moving towards a major rotation. What is that rotation? Well, an increasing preference for value over growth. In sector terms, what does that mean? It means moving away from the pandemic winners, like the technology sectors that have become extremely overvalued, and moving towards the more value areas of the market, such as in energy and also in banks. So a rotation is definitely unfolding. And here, just wanted to show you this chart here. Value really tends to perform well when interest rates are moving up the way they are now. As you can see there on the right-hand side, as interest rates move up, the performance of value also moves up. Value stocks are really concerned, not so much concerned with the monetary policy environment, but rather what is happening in the here and now in the economy. If the news is good on the economy in the present, then value stocks can rally. And that is exactly the environment that we're in. So we prefer equities, but we are moving towards a major rotation away from growth and towards value as we head deeper into 2022. All right, guys, let's go through some key questions. What is keeping us up at night? What is the main risk out there for us? Well, the major risk for us remains inflation. It is the issue of inflation, definitely, right? As we noted, the most likely scenario is still that inflation will come down fairly significantly over the coming year as the pandemic unwinds, supply chain issues resolve themselves, maybe demand comes down a bit as well. But there is a risk that inflation remains permanent, that it becomes permanent. And if it stays higher for longer, inflation can become what we call entrenched, meaning it can become kind of self-fulfilling in a sense, right? You can see this here with an example with the wage price spiral. So how does it work? So workers, they would see higher prices in the economy. They demand higher wages. As they demand higher wages, company has to raise their prices. And then of course the workers want even higher wages on top, and you kind of get this negative upward spiral of inflation. And if that were to occur, then guys, then the central banks will have to pull the brake in a major way. And there we could see a significant crash. But the good news is that these inflation expectations are not becoming entrenched in a permanent sense, is that they are still under control. But this is something that we're definitely monitoring extremely carefully. Now, how do we deal with the current geopolitical mess that's going on, right? So beyond inflation, this is definitely something that is on all investors' minds right now. So how to deal with this situation? So, I mean, unfortunately, we don't have any models that can tell us what's going on in the Kremlin, what's going on inside Putin's head, whether he will invade or not. But what we do know is that war is looking increasingly likely, right? The markets are telling us that. Right? We've seen Russian equities come down significantly. We see the Russian ruble there on the right-hand side really coming down a lot as well. We see the energy sector really starting to be boosted. And here is the important thing. If we have geopolitical friction involving a major oil producer, it tends to mean that oil prices trend up. So the way we can deal with this risk is by adding more energy to the portfolio. We've already had a significant element of energy in the portfolio, but this geopolitical risk means we need to add even more to hedge against this risk of an invasion, because oil prices will spike significantly as a result, and we need to hedge against that risk. So as we note here, hedge for us in the portfolios dealing with geopolitical risk is energy. Right, guys, we're almost there. I just want to wrap it all up for you neatly. So what have we said? We said it was a difficult start to the year, right? We've had a tighter monetary policy environment. The Fed has become a lot more hawkish. We've had a massive spike up in Omicron cases. This is causing some concern. We've had the tensions around Russia. That's posing some issues as well. But we are still favoring equities, right? A recession is still unlikely in this environment. If we have no recession, stocks can catch their footing and they can still perform. But we are rotating the portfolios towards value over growth. And in terms of the key questions out there, inflation is a major risk. This is something that we really need to monitor extremely carefully. And of course, in terms of the Russia-Ukraine situation, we need to hedge against that risk too. And in order to do that, we're moving towards energy even more as a result. But with that, I leave you. Have a fantastic end to the day. And if you have any questions, please do not hesitate to shoot them in, right? So we have a lot of questions. Maybe we'll do a special video on that to go through all of them. But please, if you have questions, please shoot them in. Do not hesitate at all. But with that said, thank you very much, everyone, for listening, and have a fantastic end to the week and hopefully a good weekend as well.